Hey guys, how's it going? I thought I would make the second part of how to start trading stocks. We had a chance to see my first video. The first step is to open an account, right? I obviously like TD Ameritrade because of Thinkorswim, but you're open to use the one that you like, whether it's Fidelity, Robinhood. There's tons of them. So just pick the one that you like. And once you have an account, you can get started on how to trade, right? And this is what the second part is going to be about. How do you actually start? Now that you have an account, what do you do? So the first question you need to ask yourself is, what type of investor are you, right? Who are you? Are you someone who is very risk adverse or not? Are you willing to take on a lot of risk and potentially lose all of your money? Or are you more conservative and want to go slowly? Depending on the size of your account as well, right, would determine how much you can invest. I recommend a moderate approach so that you're not too safe so that your investment doesn't grow at all, but not too risky that you can lose everything in one trade, right? So find a mix that works for you. And things like your age, your income are going to come into effect, but also your personality. Do you like the risk? Do you like biting your nails, like thinking what's going to happen next? Or do you prefer just to have passive income every month? These are questions you're going to have to think about. Investment psychology is a very interesting topic if you want to look more into it, or you want me to talk a little bit more about it. So what are the types of trades? We have day trading, right? Day trading is a short time frame. You're in and out, usually in the same day, at the most 2 days, but usually you enter, let's say on a Monday, and Monday, midday, afternoon, at the most, you're out. So that's one of the pros, right? You don't have to worry too much about what's going on in a larger economy, what's going to happen in the government, what's going to happen with the Fed. You come in, you come out. Leverage is another pro of day trading. The use of options can help you maximize your gains while limiting your losses. For example, if I think Apple, let's say Apple, right, it's going to go up today, I will buy a call that expires on Friday. And the most I will lose, the most I can possibly lose is the price of the call. But my gain is unlimited, right? With that said, you want to get out on the same day so that you don't suffer time decay. But I can cover that in an options video. For now, just know that the use of options can help you maximize your leverage. So you can make an unlimited amount and lose very little. Some of the cons of day trading are the learning curve, right? It's a little bit it's not mathematical in the sense that 1 + 1 = 2. You have to it's a bit of an art. You have to learn how to read different indicators, pick the indicators that work for you, and then get a feel of how that particular security moves. It's time consuming. If you have a full-time job, if you have a 9 to 5, it's going to be hard for you to keep an eye on the charts and make a trade, not only when to get in but also when to get out, right? If you are pulled into a meeting and you're in the middle of the trade, a trade that was green or positive can quickly turn on you, and that would be really bad. And that leads to the next topic, right? Risk. There's fast ups, but there's also fast downs. And it's happened to me where I was up 50, $60 on the trade and I get greedy or I get distracted. And next thing I know, I'm down 20, I'm down 30. So, when you think of risk management, you really shouldn't let a green trade go red, but it does happen. And if you're not careful or you don't know what you're doing, that can happen to you. Next, we have swing trading. Swing trading is a little more forgiving than day trading, and that yes, it does have a short time frame, but you're in and out in a few days, maybe a few weeks. So you have a little more flexibility there. And because of that, you have more room to move. Because of the larger time horizon, you give yourself more time for the moves to go in the certain direction that you pick, right? For example, if you think Apple is going to go up and you have a lot of conviction, it may not go up today. So your day trade is not going to be favorable, but it may go up tomorrow. It may go up 3 days from now, and swing trading would allow you to capitalize on that move. It's less time consuming than day trading. I don't have to look at the charts every minute of every day to be able to do a swing trade, although that's not really true. You wouldn't need to look at a chart every minute of every day to do day trading, but you would have to be able to allocate at least an hour to be able to day trade. So with that said, it's less time consuming. Learning curve. It's more intuitive than day trading. The indicators are a little more honest, and it's not as much of an art form. And again, because of the larger time horizon, it has room to move, so that would work in your favor. Some of the cons of swing trading are that it's still time consuming. It's not as time consuming as day trading, but it is time consuming. You will need to be looking at charts every day, not for an hour at a time, for example, like with day trading, but you will need to look at them. Risk, unlike day trading, there is the risk of macro conditions, right? What's going on in the Fed, what's going on in the larger market will impact you. Not as much as a long-term investment, but you will be impacted by it. And cons, another con is buying options, right? Like I said, for day trading, you can buy options and get out the same day, and theta or time decay is not really gonna affect you. But if you try to do that with a swing trade, unless it really moves in your favor and quickly, time decay will get you. And the time decay will start to eat away at your profits, if any. And if you're losing, time decay will make your losses even bigger. So that's a big risk to keep into account when you're thinking of swing trading. And then we have investing, right? This is what most people think of when you think of stocks. Invest, you must, money you will make. So when you invest, right, you're looking at a few months to a few years. And this gives the security time and room to move. You're going to have a lot of time. So there's going to be fluctuations up and down. But if you're going to have time to allow that security to go in your favor, assuming that you selected the right one, right? It's less time consuming. You can just pick one and forget it. You don't need to look at it every day. You probably don't even need to look at it every week. Just, once a week, maybe once every other, just look at it. If you decide to add, it would be a good time to dollar cost average, but it's not as time consuming as the other two types of investment. It's easier to learn. It's a lot easier to learn how to invest than it is how to trade. It's just because it has more room to go. You have more time to make adjustments, which with the other two types of investment, you have to be a little faster to react. Some of the cons, right? It's that your capital is going to be tied up in the securities that you select. This means that you're not going to be able to necessarily invest in other things. And that illiquidity is a big con of investment, right? You can see a great opportunity, but you have your money tied up in Apple or Facebook or whatever it may be, and you won't be able to partake in that opportunity. And the risk is that you will be exposed to macro conditions, right? The greater market will impact you. If we go into a recession and the market goes down 20% and you're holding on to some securities, yeah, it's going to impact you. You're going to have to, again, sit on them for a while and wait for it to go back up or take the loss. So that's a big risk. So which one do you choose, right? Am I a trader? Am I a swing trader? Am I an investor? Which one am I? Do you have to pick one? No, you could be all three. So that's something you could look into, right? Like why commit to one when you can do all three? So that's what I would recommend that you do. Pick all three. And this is how I would do it. Do all three. Spider-Man, I'm a fan. Focus on quality. Focus on quality stocks. A lot of people, myself included, look at penny stocks and say, hey, this is going to be the next Amazon. This is going to be the next Google. And it might be, but chances are that it won't be, right? Also, you see these articles saying, if you bought Amazon in 1999 and held on to a few shares, if you put $1,000 in, now you'd be a multimillionaire. True. But one, what are the chances that you would pick Amazon, right? Not that high, pretty slim. And two, if you do pick Amazon and it goes up 100%, are you really going to leave it? Or are you going to take out your money and pat yourself on the back for saying, I did a good job? You're probably going to take take the win, right? So it's really unlikely that you're just going to set it and forget it and manage to pick the big winner, the Googles, the Apples, the Amazons. So I would say focus on blue chip companies, right? Stable companies, companies that you know are going to be around in the next 10 years. Home Depot, Apple, Microsoft. These are the quality companies that have consumer loyalty. They are going to be, they were here before me and they will be here after. That's something that you want to keep in mind. You don't want to put the bulk of your money in a company that may not be around tomorrow. If you want more volatility, right? If you want that chance to really make it, you can do so. You can still do it with these blue chip stable companies, but you can do it with options. Options will give you that leverage. If you guys want to learn more about options, I will be making a video on that soon. And finally, I would suggest making investing 85% of your portfolio. The rest can be day trading, the rest can be swing trading, and that's great. But because of the safety net that you get from investing, I would say make 85% of your portfolio investing. Start with investing, get comfortable, get a feel for it. Then you can move on to swing trading and finally day trade. But day trade with a very small amount. And once you start to feel comfortable there, you can start increasing that amount. Think of it as a marathon. It's not a sprint, right? There's no rush. So how do I decide which stocks to pick, right? So like I said, I focus on blue chip, stable companies. And I'm, sharing my portfolio with you guys here. Let me minimize my face so you can see. Okay. So these are some of the stocks that I look at, right? Apple, Facebook, NVIDIA, PayPal, Upstart. And then I have two ETFs, the Triple Q, QQQ, and SPY. I'll start with these two because these two make up the bulk of my portfolio. SPY, these are ETFs, exchange traded funds, that mirror the performance of the S&P 500 as well as the NASDAQ. So over time, if you look at history, the market will usually go up. There are years, months, days when it's going to go down, but over time, the markets will go up. So rather than spending a lot of time and energy and trying to pick the next big thing, the next great stock, just put the bulk of your money in an ETF, right? That's going to mirror the market. Most hedge funds, most investment professionals can't beat the market consistently. They cannot. It's very hard to beat the market, let alone do it consistently. So don't try to beat the market. Just mirror the market. Just let the S&P 500 or NASDAQ or the ETF of your choice do what it has to do. And over time, it will go up. It may go down today. It may go down this week. It may go down this year. But over time, they will go up. So just trust the market, put your money there, and let it do what it has to do. Next, next big chunk of your money should be, or at least my money, right, should be in blue chip stocks. Like I said before, think of the big stable companies. Think of the Home Depots, the Apples, the Facebooks of the world, right? That's important. Focus on these companies. Finally, you can take a little bit of risk, but this should be a small part of your portfolio. In my case, it's going to be Upstart, a financial company, and PayPal. PayPal, most of you guys are familiar with, right? So another question you need to know is, what sector are you in? As you can see, you may think that I'm very heavy in the IT, and I am when it comes to individual stocks. But note that I have two ETFs, and you'll see in the next slide that they take up the bulk of my portfolio that mirror the entire market. So whether Apple does well or not, it's not really going to have that much weight on my portfolio because I'm mirroring the whole market. Also, you need to know, what do these companies do, right? With the exception of these two that mirror the market, like I said, who is Apple? What does Apple do? Same with Facebook, same about NVIDIA. Where are you putting your money? If you lend someone your money, think of it that way. You're lending a company your money. You want to make sure that it's a company that's going to be in business. You want to make sure it's a company that's going to be around. Like, know what they do. You may not have to be an expert on the processes of, the minor details of their day-to-day, but at least be aware of what they do, what kind of business they're involved in, and be aware of the risk, right? Like I said before, Apple, Facebook are going to be around for a while. They've been around for a while already. They're safe, stable companies. PayPal, PayPal's going through some turmoil now. If you guys follow the market, it's gone down a lot in the last few months. And Upstart is a very young company with a very innovative plan, but it may not go through. And if it doesn't go through, and if I had most of my money with them, my portfolio is going to go down with them. So I have a small part with them. So if they make it, great. But if not, it's not going to take me out of the game. So finally, I want to share some of my allocations with you, right? Like I mentioned before, if you look at SPY that mirrors the S&P 500, I have just over half of my entire portfolio with them. The QQQ has 20%. This mirrors the NASDAQ. So the almost just over 70% of my portfolio is simply mirroring these ETFs, right? Simply mirroring the market. That's all I want. I just want to match the market. I don't need to beat it. And then I have some exposure into individual companies, Apple, Facebook. These are some of the larger sectors that I have. NVIDIA, I have a small percentage with, and PayPal and Upstart, the ones that can completely blow it out of the park, but they can also go bankrupt, are very, very small percentages of my portfolio. So that's all I have for you guys. This would be the second step, right? What kind of investor are you? And allocate in companies that are quality companies. They should be the bulk of your portfolio. And again, like a very simple start, if you just want to start investment and you don't want to start investing, sorry, and you don't want to put too much time, just buy SPY, just buy QQQ. Just every time you have a chance, just put money in there and it'll grow over time. It may not grow tomorrow, it may not grow this year, but over time, the markets will go up. Just trust the market and you will see your portfolio grow. All right, guys, thanks for joining, and I'll see you in the next video.